Let's do a thumbs up, thumbs down. 50 mortgages. Good idea or bad idea?
Secret ballot? Can't see it.
Slick.
Make sure your tabs are on the correct tabs.
Slick, tricky. Do I have anything? No, I'm good. I'm good. Don't have anything.
Some podcasters zooming in.
Well, the nobody that watches this.
Yeah.
Yeah.
All of it.
That's one of the things I'm so curious about is if the market comes back, does real estate education come back? Because everybody's like dead.
Yeah.
Because why are you
dead on content or dead on views? Content?
Well, I mean, I would say they're both the same. Like they're doing content, but the views are dog shit.
Okay.
Like Bigger Pockets was purchased by a private equity group for a lot of money.
Yeah.
And then fired half the staff, maybe even more than half the staff. And I was listening to David Green talk about it with one of the other guys that was on there and kind of complaining, but they're getting 10,000 views on a video after like a week, which is insane.
Yeah.
Like insane. They should, and they're one of the biggest ones in the space. It should be, I don't know. So I do wonder about that. Like,
Wonder what it was at the peak.
Yeah.
Were they getting like 500,000 views?
Probably. I'd have to go back and look. Because like to justify the purchase, you're looking at what it's able to generate for revenue. Just like every other business. And they paid, it wasn't like they paid $500,000 for it. Like it was millions and millions of dollars.
Sure, yeah.
And now for them to be consistently doing 10,000 views a video, like, ugh, I'm sure they're like, we should have just bought Bitcoin. Yeah. Well, welcome everybody to the Nashville Money Guys podcast.
Yay.
We're at the archery shop where I do my other podcast. So it looks all dark and vibey. And
there's a weed eater or a blower in the background.
You won't be able to hear it. That's the joy of these mics.
Good.
I'll put a little sound dampening on there. When they start cutting arrows in the background, it's like,
Won't be able to hear that?
no, you can a little bit with that.
Yeah.
But it's part of the charm. Part of the charm. Not for the
Let's
real
go with
estate
that.
podcast, but it is for the archery podcast.
Yeah.
So it's been a while.
Yeah.
And we're not going to talk about why it's been a while yet,
No.
but foreshadowing into the future.
Professional tease.
Yeah, foreshadowing into the future. But we're gonna talk about the new proposal of the 50-year mortgage today that's come out.
Were you guys talking about this before I got here?
Just a little
'Cause
bit.
I don't know your take on it. It's gonna be interesting.
That's the goal. I like the. I mean, I'm sure
Surprise.
honestly we probably all feel similar about it. Is going to be my guess. Have you been doing any research on it at all?
No, I just have some general ideas of what I think about it.
Okay. All right.
Very little research here. Very little.
Okay.
But-
And what I did was I've listened to a couple of videos and talked to ChatGPT for a while about the history of mortgages in the country in general. And I found that to be really interesting when you track it to the price of housing and just the general increase.
We should talk about that a little bit too. Just the fact that we're talking with AI.
You literally had a 30-minute phone conversation
On the way up here,
Driving
literally
here,
like
just
clicked it
talking.
on and just talking back and forth about stuff. So crazy.
It makes me worried if it's not accurate. Like if it's giving you inaccurate, it's like, mortgages were formed in 1930 by Abraham Lincoln.
Yeah.
Like I'd be like, yeah, absolutely. Abraham Lincoln in the 30s, he did his thing. That was great. I'll talk briefly about the history of mortgages in the country and that, because that may inform some more of the conversation. So
Wait, let's do a thumbs up, thumbs down. 50 mortgages. Good idea or bad idea?
Secret ballot?
Yeah.
how do you do that? Wait, how do you do the thing?
You
Oh
gotta-
yeah,
you
yeah,
gotta
that's
do
right.
both
That's right.
thumbs.
That's right.
All right.
Okay.
So is this a good idea to go down this road or a bad idea? 3, 2, 1, go. Oh, okay. All right.
Well, I've got mine probably should have been a little bit more like a this sideways,
Yeah.
like exactly, like a little bit more of a neutral.
Yeah.
Well, let's go into let's just go into that before we go through the history. Why don't we talk about that, Leroy? Why don't you lead us off since you were kind of
I think
in the know.
I think it depends on which side of the coin you're looking at for if it's a good or bad. So I think in general, the negatives to society will probably outweigh the positives, just because some of the things that we were talking a little bit about earlier was the 50-year mortgage all of a sudden becomes generational, where you may never pay off this mortgage. It may pass to your kids. You know, even if you're in an early age when you get it, 30s, you may die before you get this paid off. So it would pass to your children if the intent is to stay in the house forever, if that's your final home. The other things I thought about that are negative are the fact that for retirement, a lot of people plan for their income to be down in retirement. And the idea is that you're going to pay off your house so that you free up that cash that you've been paying towards your mortgage to then fund your lifestyle. And with a 50-year mortgage, that will not happen. Like your retirement, the planning has to change because you will now be paying a 50-year mortgage during those years. And there's a few other nuances, getting into the fact that people stay in their house 7 to 10 years, is that a big factor? I don't know yet, obviously.
But overall, though, it seems like a lot of that you're talking about is the perception that people will hold the mortgages for a long, long, long time.
Correct. Yeah. And then, so that's that side of the coin. Now, on the other side of the coin, being somebody that is a seller and flipper and lender of housing, like I like it. I think it,
Right.
it increases our ability to do more houses and increases our ability to do, create things. It does get the economy moving. Some for those of people that can't potentially afford 30-year mortgages, it would get the money moving again, which money moving creates good economy. So in general,
Yeah, it's all right. What do you give me kind of the overarching?
I think the caveat is I'm probably kind of on the same page. I think for society at large, it may not be the best idea, but for real estate investors and for your person who's going to buy a house and then make good financial decisions for the rest of their life, I think it's a good thing but then the flip side of this coin is going back to the AI conversation, like how is AI and automation going to affect the affordability of housing and the ability to build more housing? And, because my argument would be you can buy more house or buy more houses if you've got longer term debt on them. So interest only or 50-year AM or whatever. You can buy more, and the way you fight inflation is to become a borrower. And so you get to borrow money and pay it back over a long period of time with ever cheaper dollars. Right. And so as an investor, I think that's wise to be able to control an asset, and then a 50-year note is going to make your obligation to pay every month lower. Doesn't mean you have to pay that. You could still pay more if you wanted to, but what you're obligated to pay is going to be lower. And so I think that's a good thing as a real estate investor. And even a good thing for people that are wanting to get into their first home or whatever, to be able to have that option to buy something, and now they have an asset, and that's going to help them fight inflation over time. The flip side of that conversation is, does real estate over time continue to appreciate like it has over the last 30, 40, 50 years?
Yeah.
And I think the answer to that is the jury's still out on that one. So
I've been thinking about that
how like we were talking about, like robots building houses.
Yeah.
Like if that actually happens, and it probably will, like can a builder build a house for $80 a square foot, like material cost plus a little bit of,
and
then
if we integrate robots into the entire system, which is what I think the guy like Elon Musk and a lot of those guys that are at that level that are creating these bots, they assume, and they're saying that they're going to sell them into the marketplace between $30,000 and $50,000. So, which seems insane to me. But you look at that's the salary for 1 year of a worker, except I can now own a robot that in theory is going to last 2 years. Hopefully it'll at least last 2 years. But if you take the entire stack that it takes to get a house from raw material into finished product, you can literally replace human beings across all of it with robots. Think about trees getting cut down in the field by robots. Insurance costs go down because the company goes, no, I'm not risking the lives of human beings out here. I'm risking the lives, even with existing infrastructure. A robot drives an excavator that already exists. Right. A robot drives the truck in that already exists. And then when they create robot-powered trucks or whatever, just the brain, then when that truck wears out, it's being replaced by the new thing. So like that's why a humanoid robot is... It's honestly, it's a little terrifying because you may be creating deflation. You may create deflation.
I mean, technology should be inherently deflationary. And so, like right now, we've got like real estate has done as well as it's done because we've had one population growth, like baby boomers, and now we're experiencing the opposite. We're in population decline. So what does net immigration look like as part of the equation? And then it's just supply and demand. Like we couldn't build enough housing to keep up with the demand for it. So if AI and automation flips that on its head, and now it's like, no, housing is plentiful, and like we want a subdivision of 100 homes right there, and then a army of robots goes in and builds that in 3 months, and there you go. Then real estate values are going to go the opposite way.
Yeah, they should. I mean, the only limiting factor is land is still limited. You know, like you can't, the old saying, you can't build more land. You know, you can't create more land. So land is a factor that you can't create more of because of the scarcity. But if they change the rules and allow you to go 6 stories instead of 4 in certain places, which we've been running into, like, why are they only allowing us to go 3 stories for the storage facility that we want? That's stupid. Like, let me go 6 or 8 or 10. Why would we not be utilizing this more? What's the limiting factor here for that?
Right.
And then you look at,
or when there's no more congestion on the freeways because of whatever technology happens, whether it's driverless cars or, I mean, there's no accidents anymore because everything's driverless. And so there's not the backup because of accidents on the interstates. Like, does living an hour outside of town where you can just get in your car and sleep on your way to work, does that make
or literally
the scarcity
have
of land
meetings.
becomes
have our meetings.
Have our meetings,
like
just driving,
our
like,
9 o'clock that we had, where because they still are going to say you need to pay attention a little bit.
Yeah.
And as those, I was thinking about this morning on the way in, because I'm watching people that are literally, everybody's texting and driving, everybody.
Yeah.
And I'm watching traffic back up, and then one car go, and then the next person go, oh, and then start to go. And that's backing up everything for miles, those ebbs and flows.
Yeah.
If you have driverless cars, all those cars communicate with each other and start accelerating at the same speed at the same time. If there's a deer that runs in front of the road and hits a car, every car around it gets alerted. That car gets pulled over to the shoulder. Those cars make room. And then the flow of traffic continues to go unimpeded. There's no rubbernecking. Well, you can rubberneck all you want, but we're not slowing down.
The police are notified and people moving out of their way, and everyone keeps moving at the same time.
Absolutely. Yeah. I mean,
or is it now we've just got many pods that are helicopter pods that you just come to your house, picks you up, takes you to where you want to go? Like, it sounds super far-fetched to say right now, but I think if you had the conversation about what's happening with AI 10 years ago right now, it would have seemed just as far-fetched.
Yeah, that's definitely potential. I think that may be a little bit more like the people that
Jets
have
and
helicopters. I think you'll see it a little bit more, but like not a ton. And Musk talks about this too. He talks about the noise pollution that's created no matter what by rotors or jets or anything like that. He's like, it's the problem is the noise. So if you get a bunch of people that are going at low altitude, with a ton of high decibel, this is not going where I thought it was going to go as a pod, but I think it's interesting.
I was going to say, and back to fix your mortgage.
But what we're talking about is we're talking about
the overall
we have
economy.
Seen this inflation in housing prices that started in the early 1900s.
Yeah.
In the early 1900s, you'd go to your local bank and you would bring between 30 and 80% down. Mm-hmm. And they would give you a small loan for the balance, and it would be interest only, and it was either a 3-year, a 5-year, or a 10-year sometimes. And it was interest only, no amortizing. So the amortizing loan, and they would have a balloon, and they said typically as long as the value is still there and you're treating it well, because this is your local bank that you're going to, these people, they would re-up the loan and just extend it. But the assumption was that you were able to be smart enough to save your money to pay that balloon at the end of the time.
Yeah.
And then in the 30s, after the Great Depression had happened, they were trying to basically figure out a way to save the banks, is what some of the stuff that I had read was. And essentially they created the amortizing mortgage at that point in time, and which is the mortgage that we see now. Now they've used amortization in the past, but this became a federally backed mortgage, and all of a sudden you see housing prices start to climb. And with every single change that they have made, they have driven demand through trying to make the monthly payments cheaper, keep the monthly payments down. Monthly payments down equals housing prices go up. Yeah. And right now we're in the next phase of that, which is going from a 30-year to a 50-year. a big change was them going from a 15 or a 20 year to the 30 year. Because if you do the math on the change between a 20-year AM and a 30-year AM, there's a big payment difference. Going from a 30 to a 50, it's not that big.
Yeah, on a $350,000 mortgage, I think it was like $300, $400 a month, maybe.
I was running the math on 500,000.
Yeah,
and the difference was about $400 a month. Yeah. That's not nothing,
right?
But the issue is, it's not double. Like for the 15-year mortgage, it was almost double practically. Right. I think that there will be people that take advantage of the 50-year, like us. I think that if we could go to a bank and they were like, you can get a 30-year mortgage at 5%, or we'll give you a 50, we would go, we'll take the 50, because what we're going to take,
bring back negatively amortizing mortgages.
Right.
But it requires a plan. And it requires discipline to understand that we're not just going out and using this and buying stuff that's going down in value. You're going to take the balance of that cash flow that you're saving and you're going to invest with it. You're going to do something
like
with that
boats
cash
and
flow.
stuff.
Boats, cars, watches. Yeah.
Bows,
Arrows. Yeah. Hunting trips. Those are experiences. Those are investments. Yeah. So net, do you think it's positive for the country if they do this, or do you think it's negative?
I think short term it's positive. I think it gets things moving again.
And you think things moving again is positive?
Yeah. I think overall, so in 2008, we're dating ourselves a little bit, but like just nothing was moving. Like there was no movement. We were one of the few that were actually buying houses that were cheap, and flipping them, but like nobody else was, like very few people. So, and it took a long time to get out. So I think movement is positive because it creates velocity, like in the mindset of things moving is much better than that of just stagnant.
That's stagnation.
So
what do you think? Net.
I think it comes back to that question about what is housing going to do, which I don't think any of us has a crystal ball to be able to know that, but I don't think real estate's going to be the golden goose that it's been for the last 40 or 50 years. Like all you basically had to do was just buy real estate and hang on to it. I'd say I'm probably, it's a non-answer, but I'm probably like on the fence, like a 50-50. Could be positive, could be negative. I do think it'll get things moving right now. But yeah, for me, there's some question marks about, is it going to make sense to hold real estate over the next 40 or 50 years? And if real estate continues to go up, it's a net positive for the country because more people are going to be able to buy real estate or buy more real estate because of it. And then they'll be able to hedge against inflation, assuming real estate goes up. But if it doesn't, then it's going to be a negative for long term for the country. So
I think it's a starving man that you say, I've got a bunch of sugar, I'll feed you. I think that it is another thing they can do to rev the engine synthetically, basically. And I'm with you on getting things moving. I'm with you on, like, you think about all the people that are mortgage brokers that are like involved in real estate and real estate stuff that have been on the sidelines for the last 3 years practically. And that's not been a great feeling. But I think overall net for the country, that 20 years of stagnation would actually probably not be a bad thing.
Yeah.
Of demand driven down by like just demoralizing all the Gen Zers, and then maybe Gen Alpha gets to have housing prices that are actually cheaper. Like that's actually, I think, how you create health. And I think what they're about to do if they do the 50-year mortgage is give a starving man sugar.
Yeah.
That's what I think. Now, I think that there will be people that do a good job with it and take advantage of it, and they buy a house when they're 25, and that's all they can afford. They get the 50-year mortgage, they refi to a 30, or they pay it like a 30, or they pay it like a 15 at a certain point in the future when their income catches up. I think there will be people that do that, but I think it will be a huge minority.
That's the thing that I think where it makes a difference is those in that younger age bracket that don't have their career yet might be able to actually afford a house at that point. And then as they move up, they create a little bit of equity, they sell it, they get a better job, they start, moving up the ladder, then they move to a 30-year or something else where they can afford.
Yeah.
So I think it lowers the barrier of entry just a little bit.
Yeah.
But
Yeah.
especially
And that
now that
would
what
be
they've,
good.
I don't know if you all saw the credit requirements, they're getting rid of that too.
How is that?
I don't know.
Who thinks that that's a good plan, though?
Now,
Like credit score?
Yeah.
my understanding is they're doing away with the score necessarily, like people that may not have a score, but still analyzing the financials and all the
Okay,
that
but I
stuff.
mean,
So,
you could
it's
always
not
go
gonna
get a
be based
mortgage
just on
score.
Yeah.
Okay, then maybe that's like an FHA reg that they're saying if you want to get a federally backed loan, we're not just going to look at your score. But like Xander, there was always those Dave Ramsey ads where they were like, they'll do it's not score based. Yeah, I can't remember what he called it, but they would basically
A
analyze
real person.
yeah, that kind of thing.
Non-qualifying or non-QM or something like that.
Yeah, I can't remember offhand. I heard Scott Bessent talking about the other potential was there's all these houses that have 2 to 3%, 4% loans on them, them basically figuring out a way to walk those mortgages to a new home. So if the person who has that mortgage could then take that balance to the new home, that would actually be really smart. Why would they not do a substitution of collateral? Like, if you were looking at it and you were like, yeah, I like your new house better, and whatever, maybe you have to have a second that's behind that high rate mortgage or behind that super low rate mortgage.
Yeah.
I don't see a ton of downside on that.
Well, they wouldn't do that because
They're greedy.
I mean, if it's a person with a brain, then you would go, no, I'm not going to allow you to do that.
It's
as
the
a lender.
government.
I understand.
That's what I'm saying. It's not people with
I
a
understand.
brain. What they're just trying to do is feed sugar, but this is a better type of sugar, in my opinion. Yeah. No, I'm with you that like we wouldn't do it that way.
That would also create movement, though, because in theory,
Correct.
you've got people behind you that are going to buy your house with the higher rate stuff. So right now, nothing's happening. Whereas you start doing that, okay, yeah, you can walk it over to here. Now here's a house that somebody else will buy that will have a potentially higher rate or a 50-year mortgage. So it just kind
I
of
think they did that in California with property taxes. Like if you're over a certain age, because they got to a point where, because in California, unlike Nashville, where property taxes go up every 4 years, no
Really
matter what. What were we paying? Was it double?
close to double.
Close to double in property taxes, and it was a big check to
In
start
4
with.
years.
Huge check.
Huge check.
But where was I going? Oh yeah, California. So they had all these old people because their property taxes are based on what you paid for the property when you bought it. So you had people that bought a house in, Rancho Cucamonga for,
That is the name of a place in California.
I think so. $3,000 back in the 60s, and now it's worth $3 million. And if they move and buy another house, then they have to pay property taxes based on $3 million. And so I don't remember if it was age based, but there was something they did where, like, if you were over a certain age, you could basically move to another house and just take your property tax with you to the new house.
Okay,
because
that's
they had the same issue of people just weren't moving.
Yeah, nobody moved.
Because like, why would you give up your $3,000 tax bill for a $30,000 tax bill?
That's interesting. I mean, and DeSantis is talking about getting rid of property taxes in Florida altogether.
Yeah,
like
for homeowners. Yeah,
yeah, that would be tremendous. Like if you think about the types of taxes where you can opt into them, like a tax that you're going to go a consumption tax. I'm going to go buy a thing and I'll pay a tax on that. Versus, nope, I'm just going to exist. Like I just want to exist in my house, and they're like, yeah, sorry, your shit just doubled.
Yeah,
like that's. Yeah, it's a horrible feeling, and I get it. We'll be in a different boat for our the investments because they'll basically tax everything commercial, and I understand that. But for homeowners, like to have that security of I now have my 50-year mortgage paid off, and I no longer have property taxes, and I can choose what type of insurance I want to have on it based on my understanding of the risk of the property. That would be really good.
They will lose so much money. I mean, the question is, like, are they replacing it with a tax where, like, a transfer tax that you have to pay when you buy or sell a house?
Yeah, I don't know. I don't know what the proposal is.
Because, I mean, like, we own a decent amount of real estate, but not a ton.
No.
And our property taxes that we're paying to Metro Nashville government is substantial.
Deep into the six figures.
Yes. Yeah. Multiple six figures.
Yeah.
And that's insane.
I know. And you're right. I don't know how you replace that. Because do you have to double? But there's probably an easy way for them to do the calculation. They just look at the sales tax numbers and they go, yeah, we increase from 9.25 to 13.5. And assuming spending stays the same, we're good. We cover it. But what that does is now you're obligating poorer people because that impacts people that are making under 50 grand. That impacts them way more. So I don't,
Yeah.
I know they'll have holdouts for food and clothes and all that kind of stuff, I'm sure. But another thing that I thought was interesting that Besson had talked about, we talked about the them being able to walk the mortgage. But there was one more thing. Oh, equity sharing, where your bank would not charge you interest for the full amount. They would hold an equity position in your home with you so that I
think I sent you all a link of a company that's been popping up on my Instagram that does that.
Interesting. And they're doing it for homeowners?
I think so.
Okay. Say a little bit more about that.
I didn't look deep into it. I just read it and I was like, oh my gosh. So it's essentially like you become a partner with the bank, and it's reverse mortgage / equity share.
Is it actually a reverse mortgage?
It was hard to say. I
Okay.
don't remember
look into it
exactly,
too
but
much.
yeah, it was something similar to that. And I was like, what?
But what would be an interesting way to do it would be to JV with somebody like a bank. Like if you want to go live in an $800,000 house,
Yeah.
but you can only afford a $400,000 house, and there's somebody that's willing to get into that position with you.
There's so many assumptions that are being made.
But like if the federal government just decided that was what they were going to do,
Yeah.
because they're just deciding to get involved with these other tech companies, like take ownership shares and board seats on companies. How could they not just be like, yeah, you know what? We like that idea. And then more sugar.
Yeah.
So like when I think I think they're kind of painted themselves into a corner a little bit here. They're like, no.
Yeah.
Housing demand been
Just
going
when
down.
I think you couldn't get any dumber, you go and pull something.
You go
like
and
this.
decide to equity share with people in their homes, federal government. I mean, that could drive demand to infinity in theory. Like if they're just willing to hold the paper and be like, yeah, no, I get it. You can only afford $1,200 a month, but you want to live in this house that's $3 million. That's fine. We'll take 90% of the equity. And you can pay your $100,000 over 50 years. That's fine.
I mean, investors have been doing those deals for decades. It's a Pete Fortunato style.
Yeah.
How would you like to live in a house you can't afford?
Yeah.
Yeah.
And then he gets either all of the upside or a portion of the upside.
I think the question is, there's no cash flow that's created by them holding that equity. So if you're doing it to convert it into treasuries, how do you pay for the treasuries? How do you pay the rate? And then the answer is, it's easy. You just print the money and then you just pay.
More, yeah.
And we go from 37 trillion in debt to 100 trillion in 5 minutes.
Yeah.
Yeah, that was the other thing. You were talking about interest rates and the amortizing mortgage, and then overlaying those two with the housing stock price. I watched a thing with Raoul Paul, who's a big crypto guy, but he's a economist, and he was talking about the balance sheets of governments and overlaying that with the cost of housing, and it's like
Just freaking
tracking right there with it. So it's not really that our real estate's getting that much more valuable. It's just the demise of the denominator.
But that also points to one of the reasons that it would be important for somebody to just get into a house at a fixed price. So like if you're paying $500,000 for it, even if you're amortizing it over 50 years, as long as that 500 is increasing by 3 or 4% every year.
Yeah. I think
But is it going to?
What is it going to?
so.
See previous conversation.
I did the math, and a lot of assumptions being, if you do a 6% mortgage at $350,000 for 30 years and for 50 years, and you sell in 10 years, basically the difference is about $50,000 in pay down.
Okay. So if you're not doing anything else with the balance and you're just you have to live on that money.
Yep.
Then you're basically $50,000 worse off by going with the 50 year.
Yeah.
So what I did
After
was
10 years.
I did a calculator in ChatGPT where I asked it to basically create two different amortization schedules for a 30 and a 50. And then if you took the difference in those payments, we're also assuming that the rate is going to be the same for a 30 and a 50, which is not going to be the case. They'll for sure charge a higher interest rate on 50. Right. But for this example, I said, if you're taking the difference and you're investing it every month, every single month, and you're getting 9% on that investment, you're actually more benefited to take the 50-year because you can basically sell the investment in year 20 and then pay the taxes on that and then pay the house off.
Yeah, that's
using the 50
what we would do.
That's what we would do.
So
that's exactly what we would do. Because we also have an outlet. Because we would take the money and we would put it in Nashville Money Guys, pay ourselves 10%, not 9%.
Yeah.
Which, by the way, that's what we do.
Yeah.
In case anybody's watching this and is interested, we take people's money at 10% and then we loan it out and we make a spread.
Yeah.
And we secure it in first position on houses that were built by human beings, not robots, until robots start building them.
For the next year at least.
Yeah. Yeah. No, I think it's going to take a while, but I think that we'll see that coming too. But I'm with you. I am concerned that real estate may not be one of the fastest horses in the race over the next 40 years, especially if the culture has changed where now some of the policies that Trump's putting in place are anti-immigration. So that's going down. We know the birth rate is declining. Like all those things create relief on housing.
The boomers are dying off.
The boomers are dying. But what's happening with their houses? They're being inherited by their kids. And if their kids have crazy high mortgages on their houses, I mean, it's that maybe they would sell their house and then just move into the boomer McMansion that's free and clear. I don't. No matter what, though, more units definitely. But they have to also be more units where people want to move.
Right.
Because like if you build more units down in Lewisburg, Tennessee, there's going to be a saturation rate that is going to be significantly slower than us building in Wedgwood, Houston.
Right.
In Nashville. Yeah, I don't know. It's going to be so interesting to see what happens. But this is like, it's the whole who moved my cheese thing.
Oh, yeah.
Is we always are paying attention. We're always trying to learn new things because in what we do, there's so many huge factors that can come in and just be like, hey, what about 50-year mortgages? And all of a sudden, boom, everybody's
changed.
back in action.
Yeah.
For better, for worse.
Yeah, the AI and automation piece of it, like it's never been like technology has always moved exponentially, but it's never moved as exponentially as it's moving right now. And so, like even like, I mean, how long ago was it that we heard about Chat GPT coming out? 2.5 years?
Yeah, probably
years?
something like that.
And to go from like hearing about that to now having conversations where the inflection in their voice and like it sounds like you're talking to a real person to like all the deep fake videos that you're seeing on like to go
wild,
in 3 years, like the progression has just been insane. Like, so I think we're all going to be shocked at what happens in another 3 to 5 years with AI and automation stuff. So
we all need places to live. Like we all need physical places to put our physical bodies. So that's one of the reasons that we still like housing. But dude, as soon as the robots start, there's a decent chance that I'm going to be like, all right, boys, we're divesting. We're gonna be getting out of this stuff. Or we're going to start doing dirt work and we're going to get us a team of robots that's building our stuff so that we can just be on the income side and then produce an income and sticking that money somewhere else.
There's always opportunity.
Of course there is, but you got to keep your eyeballs open.
You have to keep your eye on the cheese and where it's going.
Yeah.
So.
And I think that that's one of the scary parts about the 50-year mortgage is there may be people that take that mortgage out. They said 2% of 30-year mortgages go start to finish with nary a refinance the entire time. Wow. 2%.
Yeah.
So it's crazy low, but there's still 2% of people that took a mortgage out 30 years ago that was in the 6s or 7s, never refinanced. During the whole drop down, you could get into the 2s. Jocelyn's grandpa got a 1.95% mortgage on their new house.
How old was he when he did it?
80. 80. 30-year AM. He would have taken a 50. You know what he did with the balance? Invested it.
Yep.
He stuck it in the stock market. Yeah. Yeah, what's going to be crazy is AI, robots building houses, and we're going to be hoarding gold. This ancient savings technique versus robots building deflationary houses. Yeah.
Pretty
All
wild.
right. You got anything else you want to say on it?
No, I think it was good.
All right. You got anything else?
I mean, basically the answer is we don't know.
Well, nobody knows truly, but
could do that.
Nobody knows truly, but because the answer is it's going to be good for some people and it's going to be bad for some people.
Yeah.
Like there's going to be people that if you make irresponsible choices, it's always going to bite you in the ass. That's what happens though when you make irresponsible choices.
What is it? Make hay while the sun is shining.
Yeah.
Yeah.
Have you guys ever watched the Caleb Hammer YouTube videos or podcasts where he does financial audits, what it's called? It's like top 10 podcasts in the world right now. He's a younger guy. I think he's 30. And he has these like kids, people that are at 30 years and below come on. And he basically, his team goes through their whole finances and audits them and then just looks at everything, breaks it down, and he yells at them. And that's kind of the shtick. Like he legitimately gets by the end, he's yelling at people. He's Dave Ramsey, but violent and angry. But some of the stuff that these people do is they have no idea they're doing it. One girl went and got a payday loan. And she didn't understand that she was paying, it was a 67% effective interest rate on the payday loan.
Yeah.
And he was like, you've done this a couple of times. And she was like, well, yeah, I didn't want to like not pay my rent. And he was like, right. But you immediately focus on that because this is what happens. It's 60-something% interest. And she goes, right, I don't. She had no idea what that meant. No idea what that meant. And so the rich will get richer and the poor will get poorer. And the more sugar they pour into the system, the rich will get richer and the poor will get poorer and the divide will continue.
Yeah.
That's what I always say to Dave Ramsey people is debt is rocket fuel. And so if you're making good decisions and you're using debt to go buy real estate at a discount and manage it well, then that's going to rocket fuel your success and you're going to be more successful than you would if you didn't use debt. And if you're making bad decisions and then you're piling debt on top of that, that's going to, so there's, and Dave Ramsey's point is there's more risk. And that's true. But if you're calculating that risk, then it's just rocket fuel. So whichever way you're going, debt's going to, using low interest, fixed rate, long-term debt is going to usually be beneficial.
Yeah.
Unless the robots come in and start building all the houses.
Yeah.
In which case, we'll pivot.
Game's over.
We'll figure it out. Yeah.
Pivot.
All right. Like and subscribe, everybody. Thank you for staying this long. If you're here, for real, please subscribe. We have a tiny channel. It's tiny, but we're going to grow. We're going to get back into it. In the future, we're going to talk about why we took a brief hiatus here. And it's going to be good. Thanks for watching.